Classified report. First bank collapsing. As silver shorts decimated 5 major banks, holding positions they mathematically cannot escape. 4.4 billion ounces of silver promised. But the vaults, empty, one coat. 350 people demanding it back. The fire alarm is ringing. Switzerland's largest bank. Existential crisis. TD Bank stopped out at $92. But here's what they're not telling you. Every single one of them is already insolvent. The currency collapse isn't coming. It's here. And what happens next? We'll rewrite the rules of wealth forever. Welcome to John Analyst, where we decode the financial systems they hope you'll never understand. Now, if you've been around long enough to remember when a handshake meant something, when a dollar actually held its value, when banks kept your money safe instead of gambling it away, then you understand why this channel exists. Do me a favor, would you? Hit that subscribe button. Not for me, but for yourself. Because the information coming in the next few minutes could be the difference between preservation and devastation. And before we begin, drop a comment below. Tell me where you're watching from. New York? London? Mumbai? Sydney? Let's see how global this crisis really is. Now, let's get into what they're desperately trying to hide. The numbers don't lie, and right now, they're screaming. 5 major banking institutions are sitting on short positions that defy mathematical logic. They promised to deliver 4.4 billion ounces of silver. But here's the problem. That much silver doesn't exist. Not in their vaults, not anywhere. This isn't a liquidity crisis. This is a solvency apocalypse. To understand what's happening, one needs to picture a simple scenario. A restaurant coat check. A customer walks in, hands over their coat, and receives a ticket. Simple transaction. One coat, one ticket. But what if the attendant got greedy? What if he issued 35,000 tickets for only 100 coats? Everyone's happy until closing time, until everyone wants their coat back. That's exactly what these banks have done, except they're not holding coats. They're holding promises for silver they never had. The classified report from UBS landed like a bomb, marked urgent, marked confidential. Switzerland's largest bank, facing an existential crisis. Not a temporary setback, not a market correction. An existential crisis, the kind that threatens not just the institution, but the entire financial system it props up. UBS is holding a short position of 5.2 billion troy ounces. Let that sink in. 5.2 billion ounces. They sold silver they didn't own, betting the price would fall. But it didn't fall. It rose. And now, they're trapped. Here's what makes this different from every other market squeeze in history. In a normal short position, losses are limited. If someone shorts a stock at $100, the worst case, it goes to zero. They make $100. But if it goes up, there's no ceiling. It can go to 200, 500, 1,000. Losses become infinite. With silver, the dynamics are even more dangerous. Silver is a physical commodity. There's only so much of it. And when institutions promise to deliver what doesn't exist, they create a ticking time bomb. Right now, they have one coat, and 350 people want it back. The dominoes are already falling. TD Bank got stopped out. Their silver short position hit the pain threshold at $78, then $92. The internet exploded with confirmation. Multi-million-dollar positions liquidated, but TD isn't alone. Every major institution that thought they could control the silver market is bleeding, and bleeding badly. The headlines are everywhere now. Silver shorts burned alive. Major banks face catastrophic losses. Currency collapse accelerates. This isn't fear-mongering. This is documentation. Meanwhile, the broader economy tells the same story. 92% of employed Americans are cutting back on spending. Not the unemployed, the employed. People with jobs, with paychecks, are struggling. Why? Because their standard of living is crumbling, their purchasing power evaporating. While banks gambled on silver falling, real people watched their savings lose value every single day. The insolvency isn't limited to one bank, or 2, or 5. The entire system is insolvent. Citizens believe their money sits safely in bank vaults. It doesn't. Banks don't hold deposits. They lend them out. They leverage them. They gamble with them. Fractional reserve banking means for every dollar deposited, only a fraction remains. The rest, gone, loaned out, leveraged, bet on markets. And when those bets go wrong, when silver rises instead of falls, when 35,000 people want their 100 coats back, the entire illusion collapses. This is what a commodity supercycle looks like. Not from the textbooks, not from the safe distance of history. This is it, happening now, in real time. The metal they promised to deliver has vanished. The vaults that were supposed to hold it, empty, and the positions they're trapped in, mathematically inescapable. There's no way out, not without catastrophic losses, not without taking down institutions, maybe entire markets. The coat check attendant is sweating now. Closing time has arrived. The customers are lining up, tickets in hand, demanding what they were promised. And he's looking at 100 coats for 35,000 people. What happens next? That's not speculation. That's mathematics. Cold, brutal, inevitable mathematics. The question isn't if the system breaks. The question is how many people understand what's coming before it's too late. December 1971, a date most people have forgotten, but the markets, they remember. Because on that day, everything changed. President Nixon stood before cameras and made an announcement. The United States would no longer honor the gold standard. No more backing, no more accountability, just trust us. Trust the government, trust the system. And for 53 years, people did, until now. Before 1971, a dollar meant something specific. It represented actual silver, actual gold, physical metal sitting in a vault somewhere. If someone walked into a bank with a dollar bill, they could exchange it, get the real thing, the tangible asset. But Nixon called it outdated, unnecessary. He convinced the world that paper promises were enough, that citizens didn't need the option to convert. That faith in government was stronger than faith in gold. Tricky Dick, as history remembers him, pulled off the greatest financial illusion of the modern era. Here's what happened to that dollar since then. In 1971, $1 bought $1 worth of goods. Simple math. Today, that same dollar has lost 99.5% of its purchasing power. 99.5%. It buys almost nothing. A candy bar costs more than an entire meal used to. A gallon of gas costs what a tank of gas once did. A house that sold for $30,000 now sells for $300,000. But here's what they don't tell people. The dollar didn't weaken. The dollar collapsed. Slowly, quietly, deliberately. Now compare that to silver. In the 1920s, silver was $1 an ounce. $1, 1 ounce. Direct correlation. By 1971, still roughly $1.30, stable, reliable. Then Nixon severed the connection, and silver began reflecting reality, not the manipulated, controlled, artificial reality of paper currency, but actual, measurable, economic reality. Today, silver sits above $90 an ounce, but that's not because silver became more valuable. It's because the dollar became worthless. The purchasing power analysis reveals the truth. Someone who saved $100 in 1971 loses 164% in real value today. Everything costs more. Not because things got expensive, but because money got cheap, printed endlessly. Meanwhile, someone who converted that $100 into silver, they preserved their wealth, protected it, multiplied it. That's not speculation, that's documented historical fact. This is where the system reveals its design, assets versus liabilities. Most people spend their lives accumulating liabilities. New cars, new phones, credit card debt, student loans, things that lose value the moment they're purchased, things that drain wealth instead of building it. But the wealthy, they accumulate assets, stocks, real estate, precious metals, gold, silver, copper, platinum, things that hold value, things that appreciate when currencies collapse. Here's how the truly sophisticated operate. They buy assets, then they borrow against them at 3% interest, maybe 4%. They never sell, never trigger a taxable event, never give the government its cut. They just leverage, use cheap debt to acquire more assets. While everyone else works for dollars, they work for equity, for ownership, for tangible wealth that survives currency debasement. This is what every millionaire understands, what every billionaire practices, what the system doesn't want average citizens to figure out. The government keeps spending, deficit after deficit, printing money to cover shortfalls, devaluing every dollar in circulation. And households? Drowning in bad debt, consumer debt, debt with no asset backing it, debt that funds depreciating purchases. There's good debt and bad debt. Good debt buys assets that appreciate. Bad debt buys liabilities that evaporate. Most people have it backwards. And their wealth disappears accordingly. Right now, the alarm is sounding. Not a future warning, a present emergency. The coat check scenario isn't hypothetical anymore. People are lining up, demanding their silver, demanding their gold, demanding the physical assets they were promised. And the banks, they're realizing they issued far too many tickets for far too few coats. This isn't a gradual decline anymore. This is a full-blown currency collapse, the kind economists write about in history books, except it's happening now, in real time, to real people, with real savings. The question isn't whether the dollar survives. The question is what people do before it completes its collapse. Do they hold paper, or do they convert to assets? Do they trust the system, or do they trust mathematics? Because December 1971 wasn't just a policy change, it was the beginning of the end. And 53 years later, the end is arriving, right on schedule. The last time this happened Stocks dropped 58%. 58%, not a correction, not a healthy pullback, a devastation. Retirement accounts cut in half. Portfolios obliterated. Wealth evaporated overnight. And right now, every technical indicator is flashing the same warning. History doesn't repeat, but it rhymes. And the rhythm is getting louder. Professional traders don't guess. They read signals, patterns that have played out thousands of times across decades, patterns that don't lie. Right now, the NASDAQ is painting a picture, and it's not pretty. There was a top, a clear resistance point. Price tried to break above it, failed. Then the indicator turned purple. That's not arbitrary. Purple means distribution. Smart money selling to dumb money. Institutions unloading to retail investors who think they're getting a deal. Then came the close below the Bravo 9, a technical level that separates momentum from exhaustion. When price closes below it, the character changes. Bullish becomes bearish. Optimism becomes caution. And the next move? Downward, toward the trend line. That's where fortunes get made. Not by hoping, by positioning. By understanding that markets move in waves. And right now, the wave is cresting. But there's more. A formation developing that technical analysts recognize immediately. A rising wedge, price moving higher, but within narrowing boundaries, like a spring coiling tighter and tighter. Eventually, it breaks. And when rising wedges break, they break down, not up. The indicators confirm it. Multiple resistance levels stacked above, each one a brick wall price has to climb, and below, support levels waiting to catch the fall. First stop, here. Then, here, then, all the way down here. This is healthy. Markets need pullbacks. They need to exhale after inhaling. They need weak hands shaken out so strong hands can accumulate. But for traders who understand the signals, pullbacks aren't scary. They're profitable, extremely profitable. Now, shift focus to silver, the metal everyone's talking about, the short squeeze everyone's been waiting for. One trader, a student learning the system, made a decision. He switched from trading the NASDAQ to trading silver. Why? Because the opportunity was screaming. 2-minute chart, precision entries, precision exits. He entered 2 contracts at $600, exited at $625, walked away with $1,225. In minutes, not hours, not days, minutes. Well, that's the difference between owning physical silver and trading silver futures. Physical silver sits on a desk, pretty, shiny, but static. It doesn't generate cash flow, it doesn't compound, it just sits there, a store of value, important, but limited. Trading silver futures, that's active wealth generation, clicking buttons on a screen, leveraging positions, multiplying capital. A 2% move on one contract, $50,000. A 2% move the other direction, another $50,000, $100,000 swings. And with leverage, the trader doesn't even need the full $100,000 in the account. They need a fraction. The rest, borrowed from the broker. This is where the whale watcher comes in. An indicator designed to catch the big moves before they happen. And when institutions start accumulating, it signals. When price stretches too far, it warns. When a reversal is imminent, it alerts. The phone buzzes. Get ready. Eyes come on. The visual confirmation that something big is about to move. And traders who pay attention, they position accordingly. The 2-minute silver chart tells the story in real time. White line, that's price, moving across the screen. Indicators stacked below. When price beats down, accumulation phase. When eyes come on, anticipation phase. When it pops, execution phase. Run it up, capture the move, exit before exhaustion, then wait for the next setup. This isn't gambling. This isn't guessing. This is systematic, repeatable, scalable. A trader with $250,000 in their account, making 1% daily, that's $2,500 every single day, compounded over a year, not 365%. The real math is exponential, because each day's gain becomes part of the next day's capital base. But here's what most people miss. The trader isn't just clicking buttons randomly. They're running multiple vehicles, self-driving algorithms working around the clock, making trades while they sleep, while they eat, while they live life. And with the profits, they're buying the physical assets, copper, silver, gold, stocks, real estate, lots, building a fortress of wealth that doesn't depend on one strategy, one market, one outcome. Right now, 98% of people are doing it backwards. They're asking, why would anyone get into real estate this year? It's horrible. Exactly. That's exactly when to get in, when everyone else is running away, when fear is maximum, when prices are compressed. Buy low, sell high, not buy high, sell low. Yet that's what the masses do every single time. Silver was below $30. That was the accumulation zone, the time to build positions. Bitcoin will probably always go up. Silver will probably always go up. Gold will always go up. Probably. That word matters. Because in trading, certainty is an illusion. What matters is probability. And right now, the probabilities are shifting. Bitcoin isn't just moving, it's telegraphing its next move. For those who know how to listen. The chart doesn't lie, it never does. Bitcoin formed a bull flag, a continuation pattern that typically resolves upward, but there's resistance ahead. Not one level, multiple levels, stacked like stairs. First, the yellow line, price approaches, struggles, faces rejection. Then, the blue line, another battle, another test of conviction. Then comes the purple line, the 200-day moving average, the line institutional traders watch religiously. When price hits it, decisions get made, big decisions, and lurking beneath all of it, the Chick magnet indicator, pulling downward, creating gravitational pressure, suggesting that despite the bull flag, despite the momentum, there's still downside risk, still a path lower. When price reaches the upper resistance zones, it becomes overbought, stretched, vulnerable. That's when smart traders start scaling out, taking profit, reducing exposure, not because they don't believe in Bitcoin long term, but because they understand cycles. Here's the bigger picture. The elephant in the room, a pattern forming that technical traders recognize instantly. Left shoulder, head, right shoulder, a head and shoulders formation, one of the most reliable reversal patterns in technical analysis. If it completes, if the right shoulder forms and price breaks the neckline, Bitcoin doesn't go to 150,000, it goes down, significantly down. This is where emotion and analysis separate. When Bitcoin was at the top, when everyone was euphoric, the message was clear. Get out, take profit, this is it. But people didn't listen. They called it stupid. They said the analysis was wrong. They cited supply and demand. Only 21 million Bitcoin will ever exist. Scarcity guarantees value, right? Wrong. Scarcity matters. But so does price discovery. So does market cycles. So does human psychology. The current price sits at 97,000. Respectable, strong, but not immune to correction. The analysis suggests a move down, maybe to 60,000. Nobody knows the exact bottom. But the accumulation zone, that's identifiable. 60,000 becomes interesting, a level where support and resistance converge, where historical activity clusters, where smart money starts building positions again. This is where leverage becomes a weapon, not for the reckless, not for the gamblers, but for those with strategy. $10 million base capital, leveraged to 100 million, deployed in the accumulation zone. This is what separates investors from traders. Investors buy and hold. They believe in the long-term story. They accumulate and wait. Traders, they participate in the cycles, they buy the fear, they sell the greed, they extract profit from volatility. Both strategies work, but they require different mindsets, different disciplines, different executions. The framework for 2026 and 2027 is clear. Accumulate assets during crisis, deploy capital during fear, take profit during euphoria, teach the next generation these principles, because wealth isn't built by accident. It's built systematically, through understanding cycles, through recognizing patterns, through having the courage to act when others freeze. Physical silver sitting on a desk, it's insurance, it's wealth preservation. It's the coat that actually exists when everyone else is holding tickets. But trading silver futures, that's wealth multiplication, that's active income generation, that's turning market volatility into tangible profits. Same asset, different strategies, different outcomes. The current moment offers something rare, multiple asset classes presenting opportunities simultaneously. Bitcoin in a technical setup suggesting future accumulation zones. Silver completing a massive short squeeze. Real estate depressed by fear and high rates. Stocks forming topping patterns that create short opportunities. For those who understand the signals. For those who've done the work. For those willing to act when it's uncomfortable. This is generational wealth territory. But it requires something most people don't have. Financial literacy. Not the kind taught in schools. Not the kind promoted by mainstream financial advisors. The real kind. The kind that understands leverage. The kind that reads technical indicators. The kind that distinguishes between good debt and bad debt. The kind that accumulates assets instead of liabilities. A course exists. A system exists. A methodology exists. It costs $3.99, 2 complete courses, everything needed to understand futures trading, to read charts, to deploy capital strategically, to multiply wealth systematically. The price is irrelevant, the value immeasurable, because the information inside, that's what changes lives, that's what builds dynasties. That's what separates those who survive currency collapse from those who thrive during it. The mathematics are simple, cold, brutal, inevitable. The banks issued too many tickets. The coats don't exist. The currency is collapsing. The assets are appreciating. And the opportunity, it's sitting right here, right now, visible to those who choose to see it. This isn't financial advice. This is economic observation, pattern recognition, historical analysis. What individuals do with this information, that's their decision, their responsibility, their future. But the data is clear, the signals are flashing, the moment is now, and those who act, they'll look back at 2026 as the year everything changed, the year they stopped being victims of the system and became architects of their own wealth. The fire alarm is ringing. The question is simple. Who's listening?